What if you took $100,000 and put it into just 3 index funds? No stock picking, no stress, no checking the market every single morning. Because here's the truth. $100,000 invested in the right 3 index funds today could quietly grow into something that completely changes your financial life forever. And in this video, we're going to show you exactly what that looks like. We're breaking down the 3 best index funds you can buy right now, how to split your $100,000 across all 3, and what your money realistically grows into over 10, 20, and 30 years. By the end of this video, you'll know exactly which funds to buy, exactly how much to put in each one, and exactly what to expect. So let's get into it. First, real quick, what is an index fund? An index fund is simply a basket of stocks that tracks a market index. Think of it like buying a tiny piece of hundreds or even thousands of companies, all in one single investment. Instead of betting on one company, you're betting on an entire market. And historically, the market wins. The S&P 500, for example, has averaged around 10% per year over the last 50 years. Through crashes, through recessions, through pandemics, it just keeps going up. That's the power of index funds. Low fees, massive diversification, time doing the heavy lifting for you. And with $100,000, time becomes very powerful. Let's see why. Fund number 1, VOO, the Vanguard S&P 500 ETF. This is the foundation of our $100,000 portfolio. And there's a reason this is the fund Warren Buffett himself recommended for everyday investors. VOO tracks the S&P 500, the 500 largest companies in America. We're talking Apple, Microsoft, Amazon, Google, the giants that run the world's largest economy. Now here's what makes VOO so special. The expense ratio, that's the annual fee, is just 0.03%. That means for every $10,000 you invest, you pay just $3 a year in fees. Basically, nothing. And the historical return? Right around 10% annually, on average, over the long run. So out of our $100,000, we're going to put $60,000 into VOO. It's our anchor, our bedrock, the part of the portfolio that keeps us stable and growing no matter what the market does short term. With $60,000 in VOO at a 10% average annual return, in 10 years, $155,624. In 20 years, $403,649. In 30 years, $1,047,745. That's the magic of compounding. Your $60,000 quietly turning into over $1 million, just sitting there, growing. Fund number 2, QQQ, the Invesco NASDAQ 100 ETF. Now this is where we add some rocket fuel to our portfolio. QQQ tracks the NASDAQ 100, the top 100 non-financial companies listed on the NASDAQ exchange. And this index is heavily weighted toward technology. We're talking NVIDIA, Apple, Microsoft, Meta, Tesla, the companies that are literally building the future. Here's where it gets interesting. QQQ's average annual return over the last decade, closer to 17 to 18% per year. Now, that comes with more volatility than VOO. QQQ swings harder when markets drop. But for long-term investors, that volatility is opportunity, not risk. Because here's what happens with $30,000 in QQQ at even a conservative 14% average annual return. In 10 years, $111,178. In 20 years, $411,391. In 30 years, $1,521,681. Your $30,000 turning into $1.5 million from one fund. We're going to put $30,000 of our $100,000 into QQQ. This is our growth engine, the part of the portfolio that chases the future. Fund number 3, SCHD, the Schwab U.S. Dividend Equity ETF. Now this is the fund most people overlook, and that is a big mistake. While VOO gives us stability and QQQ gives us growth, SCHD gives us something different. It gives us income. SCHD tracks high-quality U.S. companies that pay growing dividends. Companies with strong balance sheets, consistent cash flow, and a long history of raising their dividend payments year after year. Think Coca-Cola, Home Depot, Verizon, Texas Instruments. These are boring, profitable, dividend-paying machines. And here's why SCHD is special. It doesn't just pay dividends, it grows them. The average dividend growth rate for SCHD is around 10 to 11% per year. That means your income keeps going up automatically. The current dividend yield sits around 3.5%. So on your $10,000 invested in SCHD, you're earning $350 a year in dividends. That number grows every single year without you doing anything. We're putting $10,000 into SCHD. It's our income layer. The fund that starts putting money back in our pocket while VOO and QQQ build our wealth in the background. So here's how our $100,000 breaks down. VOO, $60,000, stability and core growth. QQQ, $30,000, high growth technology. SCHD, $10,000, dividend income. 60% foundation, 30% growth engine, 10% income layer. This is a portfolio built for long-term wealth. It's diversified, it's low cost, and it's designed to grow whether markets go up, down, or sideways. Now, here's the moment you've been waiting for. Let's see what this entire $100,000 portfolio looks like over time. Using a blended average return of around 10 to 11% annually across all three funds, portfolio value 10 years, approximately $259,000. 20 years, approximately $672,000. 30 years, approximately $1,745,000. $100,000 today, over $1.7 million in 30 years. And remember, that's without adding a single extra dollar. That's just your $100,000 sitting in 3 simple index funds, and compound interest doing what it does best. This is why the best investors in the world don't try to be clever. They don't day trade. They don't chase hot stocks. They buy great index funds, they hold them, and they let time do the work. VOO QQQ SCHD. 3 funds, $100,000, and a financial future that most people never even come close to. The best time to invest was yesterday. The second best time? Right now. If you want to keep building your investing knowledge and your portfolio, make sure you subscribe so you never miss a video.